So today we're going to talk about one of the most important elements of your success as a trader, and that is perfecting your trading setup. Now, consistency. This is often talked about as the holy grail in trading, if there ever was one. And mastering your setup, well, that's the important part of achieving it. So first, let's just define what a setup is. Essentially, it's just a predetermined set of conditions that have to be met before you enter a trade. So it's a blueprint. Has your exit strategy, your entry strategy, even your position sizing. So the entry points. These are the specific conditions that signal the best time for you to enter a trade. You have to recognize these moments every time they happen. Your exit strategy. This is vital for exiting your trade, both in profit and as a loss-cutting measure. And position sizing. This is essentially how much capital are you willing to risk on each trade. Now, there's different types of trading setups out there. You've got trend following setups, and these are designed to capitalize on the momentum of an existing trend. And for these, a lot of people will use a moving average or a trend line to confirm the direction of the trend. So a trader might enter a long position when a shorter term moving average crosses above a longer one. That gives you upward momentum. Or a trader in a strong uptrend might look for a pullback to a moving average or support as an entry point. And they're looking to ride that trend as a continuation trade. We have counter trend setups. These look to profit from reversals or corrections in the market. So they just involve entering trades against the current trend, typically at points where the market looks like it's overextended. Some traders will use the RSI to identify an overbought or oversold conditions, and that can be an issue by itself. And also divergences between price and an indicator can also help you find potential reversals. You have breakouts. These are setups that look at capturing a price movement when the market breaks through established support or resistance levels. Sometimes these setups just signal the start of a new trend. Sometimes they don't, they fail. So traders will watch for a consolidation or a trading range. You can see the defined boundaries on them. And a breakout occurs when price closes above these levels. If you see increased volume, even better. And range bound. This is where prices are going up and down between two well-defined boundaries. So traders will buy at the lower boundary, support, and sell the upper boundary, resistance. But the key to that is just making sure you can identify a stable range. Just be aware of those breakouts that could lead to losses if you do not manage your stop loss. We also have tools to help identify these setups. You got chart patterns. These are some of my favorites. And that's the head and shoulders, double top, flags. These can all indicate potential price movements. Indicators, the moving average, RSIs, MACDs. These can provide additional confirmation for your setup in a tested strategy. And of course, support and resistance levels, key price points where price movement often pauses or reverses. That will give you entry and exit opportunities. But having a setup, that's only part of the equation. Proper risk management, this is the key for longer term success. And it starts with setting your stop order. This is going to limit a potential loss on each trade. This is going to allow you to protect your capital. And calculating a risk-reward ratio. Now, these are no guarantees, but it gives you the potential profit of a trade. And will that justify the risk that you are taking? But you have to refine your setups. And you do that through backtesting and optimizing. And backtesting is just using historical data to validate your setups. Assess their performance over time, even though it doesn't matter if it worked for the last 20 years. It may not work tomorrow. You never know. And optimizing, this is just adjust your parameters to enhance the results, but you got to be mindful of over-optimizing it. This is going to lead to unreliable outcomes in live trading. And as you perfect your setups, you got to be aware of some common errors people make. Overtrading. This is taking too many trades out of impatience or the fear of missing out. And why does this happen? Well, we all have these emotional triggers. We can see others profit from trades, or we experience a losing streak. That's going to push us to make decisions that we probably should not be making. And the thing is, the constant availability of markets and access to platforms, well, this can also tempt you to over-engage with the market. So to solve that, have strict entry and exit criteria based on your plan, and have a trading journal. Document each trade you take, the rationale, the outcome, and any emotional forces that were part of that decision. And limit your trade frequency. We call it the power of quitting at NetPicks. Just set a maximum number of trades per day or week to prevent over trading. And always focus on the quality of the setup over the quantity of them. Ignoring market context is a huge one. Understand the overall market conditions, the broader context, what you're trading in. And why this happens and is a problem is a lot of times traders become too focused on an indicator or a specific setup, but they don't see the bigger picture that maybe we're not trending, so your breakout plan is not going to work in a non-trending market. Just be aware of what the market context is. And failure to adapt. You got to stay flexible. You have to adjust your strategy because things change, right? Markets are dynamic. They always change. So you may have to adapt your strategy and your setup. And again, this is that trader who has only a breakout strategy continually trying to do it in a range-bound market, or they like upside breakouts, but we are currently in a bear market or a correction. A trader may become attached to a certain setup or a strategy that's worked for the last few years, but the market's changed, but they didn't, and now they have losses. And finally, the whole crux of this video, develop a personal trading plan. That's going to incorporate everything we just talked about. And this is essential. This plan has to be a living document that lives and breathes and changes, and it evolves as you gain experience and as the market conditions change. This is vital for your success. Perfecting your trading setup, perfecting your trading routine, it's an ongoing process. And mastering your setup can enhance your consistency, but there's no guarantees, right? So that's why risk management and always adapting is so important. Thanks for watching. Don't forget to like this video, subscribe, share your thoughts in the comments, and we'll talk to you soon.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.